Well, we'll
It's
we'll
hard for me
see
to pick
we'll
the
see
right
if
levels.
We'll see if Michael can answer the question then. Welcome to the space, Michael. Thank you for taking the speaker tag. Bands is asking a great question, I think, as a newer trader. Just he feels he's drowning a little bit, it sounds like, within his own annotations. I don't know if I also have quite a few annotations and I look at a lot of things, but I try and really switch them on and off depending on quite a few annotations. And I look at a lot of things, but I try and really switch them on and off depending on what I'm looking at conceptually. So, Michael, any thoughts? We'll come back. He'll,
Can you hear me?
yes, sir, we can. Yes, sir, we can.
Sorry. I'm having issues with the X day. It's giving me a
It's
glitch.
undefeated, brother. We know.
Mhm.
We know it's undefeated.
Let me just say this, and I want to listen to the rest of you guys. Don't feel like I'm slighting any of you, but it's a good question, and I get it a lot in comments on the video channel and emails. So, and people actually send me text messages too, which I wish they wouldn't do that, but I get it. The question is how to keep your charts from being so cluttered. And it gets back to being organized and being very disciplined about what it is you're looking for. If you use TradingView, whatever platform you use, you're welcome to create a workspace that allows you. A good platform will allow you to have different workspaces. But TradingView, you can create a workspace for Monday, first presented fair value gap, okay? And you put that on there, the first presented fair value gap on Monday, name that workspace as such. And then anytime you want to refer back to it, you just toggle to that one, and it'll be there. You can do it with the object tree, but I like the workspaces because, opening ranges over the last 3 days, you can keep a workspace open just for that. So it doesn't have always these things populated with their gradient levels on it, where it can appear as like it's way too many things. So I don't like to have a lot of stuff on my chart. And when I'm trading, I don't have that stuff there. I have it in numerical format on a piece of paper. So I'm referring to it there. You may not find that helpful. It may be a little bit harder for you to do it that way. But if you do workspaces where you create and save, in the upper right-hand corner, there's an area where you can rename the workspace or whatever. Name it to whatever your specialty is that you're trying to highlight, that you don't want to have always on your chart, but you want to have a way to toggle to real quickly. First presented fair value gaps for the week, with the one that with like Mondays when it forms. Create that one every Monday. Every Monday you should have a workspace created where the first one that presents itself on Monday, you toggle it, project it to the right continuously all through the week. You're going to keep referring to it. Know what those levels are, though. Don't just look at it visually and say, okay, I want to keep coming back and see if it's near. You should know what the high and low of it is. It's not a complex thing to do that. If you're being a specialist and you're worried about one market, it's going to be easy for you to know what the first fair value gap range is without even really need to call upon it visually. And that's a level of dialed in that you'll have if you care enough. If you don't care enough, then you're going to be always referring to, I got to see it visually on the chart. In the beginning, that's a normal thing. But over time, maturity will dictate that you don't necessarily need to have that because you'll know what the high and low is for the first presented fair value gap on Monday. But then you add the 9:30 opening range and the PM session, 1:30 to 2 o'clock, that range of 30 minutes, extend those on that same workspace and label them. You're not going to have a plethora of them, but you're going to have a lot if you're adding all these other things that you're working on your go-to workspace where you're looking at everything minute by minute. Do you know what I'm saying? Like, it makes sense by doing it that way, where you can just go to one workspace that specializes in first presented fair value gaps. Then you can do one that has the opening ranges over the last 3 days, and you drop one off as you create the new one that forms the day of trading that you're watching. Just mute or quiet, and don't display it with the object tree, the one that's 4 days ago. And you always have a workspace where you just toggle and you say, okay, where am I at in reference to that range, or where we're at in an overlapping of these opening ranges. That way you're not populating your chart with a lot of information that's very distracting, and it'll also train you to know what those levels are, and you won't need to be so fixated on seeing it visually because you're still 60 handles away from any meaningful level as it relates to the last 3 opening ranges because we've extended up or lower. So it's not information that needs to be on your chart all the time, but you also know enough because you keep going to it and you've now made a mental note of it, that you're not needing to go back to it constantly. You don't have to be feeling tethered to having that stuff on your chart all the time, because you're managing the information and the flow of information that provides you. Because if it's not in close proximity, then it's useless to you. Does that make sense?
Yeah, that helps a lot. I appreciate it.
I just want to add quickly, one of the reasons why I developed as many quote unquote indicators, which aren't like the RSI and the typical things that we've looked at over the years, but it's to automate these annotations, because at times they can be laborious. It can become a lot. There are a lot of concepts. So being able to flash something on or off, and I think Michael, what he's saying, I mean, obviously, is like a new trader, you need to be doing these annotations yourself. There's nothing better than you annotating your chart the way Michael shows you how to do it within these concepts, and following the assignment for the week and within what's happening in the mentorship. So I think there's levels to that. The annotation is super important. And the more that we do it, I mean, sometimes we automate those within our own kind of code, and PineScript, that's not hard. Turning those off or on then makes all of that manual annotation a little easier. So I just wanted to add that note quickly, because as someone that trades a lot of Michael's concepts, struggling with annotation is very much a thing, because there are a lot of things that we're looking at. But there's ways in which you automate that. There's ways in which you become more familiar with that over time. So,
If I may expound a little bit more, because
yes,
it
sir.
kind of like inspired me something else. I think that obviously when I lecture on something, or I use something in a trade example, and so this and so that, whatever, and the logic around it, um, it's natural for the tendencies to rise up in a student to think that, okay, well, he taught this, so I have to have it in my chart all the time, and having it there is a comfort because it's there visually. They don't necessarily know exactly what to do with it entirely yet, but they feel comforted that it's there. But then they start feeling bothered by it because it's very distracting, having lots of things on your chart, like billboards going down a highway trying to get you to do things you really shouldn't be doing. The information that it provides needs to be weighed in context. Now I'll give you an example with a few things here. You're bullish. Your weekly analysis suggests that we're probably going to go to a inefficiency that's 150 handles above us, just hypothetically speaking. That would be a context for me to feel like, okay, even if it doesn't go to the single high that I think it may be drawn to for buy side, or relative equal highs on the weekly chart that may be the buy side liquidity, if there's an inefficiency just before that that we haven't traded up into yet, like a SIBI, that's like a loaded deal for me. That's like the easiest bias that anybody can arrive at, especially after they have seen a daily or weekly sell side liquidity pool raid and purged it. Now it's moving higher. Where's it going to go to? It's obvious it's going to go to the inefficiency. Even if it goes up the institutional order flow entry drill, it still offers 150 handles between market price and where it could go to the low of that inefficiency. There's a premium on the weekly chart. So that's a deadlock right there. Bullish bias going into the daily chart every day, looking for something bullish. How do you equate that to useful information derived from all of these things that you populate on your chart? Well, with opening range, you ideally want to see an opening range gap high, premium gap opening, and then it trade down into the gap. And we want to see it leave some of that gap open. We don't want to see it completely close it in and then start to rally up. If it leaves the opening range after coming down, leaving a portion of it open, what is that indicating? It's underlying strength. It's pushing away the tendency for it to want to go lower, because if it's weak, it's going to go lower. If it's strong, it's going to say, I'm not going to give a discount to much people that's looking to go long. We're going to prevent the opportunity for more people to dogpile on this. It's going to go higher. So the algorithm will spool higher, leaving that inefficiency open to some degree on the opening range. And then you can start looking for first presented fair value gap. And you're not going to worry so much about the lower portion or lower half of the opening range gap, because you already got the information arrived, delivered to you on a silver platter, what you're looking for, because primarily weekly charts indicating it's bullish. You have a PD array and you have a supporting PD arrays that even if you're wrong about not going to the ultimate high on the weekly chart, there's an inefficiency you could reach to. And even the worst case, it only just trades just into the low of the old CIVI that's shown on the weekly chart. Now I'm saying a lot of things very quick, so I hope I'm not confusing most people, but if you've been with me for a while, you know what I'm talking about. You have a bias, and you want to start seeing daily chart and lower time frames start indicating that it's not willing to go lower to fill all the inefficiency. And we start with the opening range gap. And then we can move to the first resistance area gap in 10 o'clock hour. And then now you have no necessity for the lower half of the opening range gap. You have no necessity to concern yourself with anything else except for that first resistance area gap from the 10 o'clock hour. And then does order flow start supporting bullish down close candles? It supports price, and short-term highs are broken out to the upside. It's showing you order flow is bullish. That's a proper example of managing the information that's provided with what I teach. And once you get the information from it and its usefulness is absorbed into your decision-making concepts, then you move it aside and you go to the working workspace where you are aware of what these levels are. And if you need to toggle back to it, it's there. But you don't have to have everything on your chart, because once you get the information you're looking for to qualify a setup that meets the criteria that's unknowingly bullish or bearish, you want to have as little as possible on the chart, because you don't want to second guess anything. You want to keep your focus narrowed down to what's important right now, what's the most impactful thing at this moment, and filter out all the other things. So, indecisiveness is very paralyzing. And the more things you have on your chart, it's going to be easy for you to fall into that. So how I teach is to help manage the information that you collect from this information itself, the PD arrays, but you're not supposed to constantly, like a straw, constantly be drinking from the cup of, every individual PD array. Like they have a life cycle, they have a measure of importance, and once they give you the information they are supposed to give you, the intelligence that you should have by having studied them in past moves, once that information is delivered to you, they have exhausted their usefulness at the moment. Doesn't mean they can't be reclaimed later on, but at the moment, then you shift to, is order flow bullish if I'm bullish? Is everything indicating that it's going to go higher? And then try to get into the trade based on that information, because you're looking at higher time frame charts to quantify whether they're bullish or bearish. You're using bias based on things that's going to be a higher time frame weekly chart, so it's not delivered on, it can be delivered on 1 day basis, but you're expecting it to deliver over the span of a whole weekly range. So you're not depending on it being immediately responding and it delivers all one shot, like a big blow off move. So you have to submit yourself to the information as these concepts give it to you, cycling through one piece of information, one concept, and they're all supporting one another. But it gets down to simply, once you get the information from it, you don't have to have it on your chart. It doesn't have to be there, but you need to be able to call upon it when it is useful to us. For instance, if say the first percent of everybody got indicates that it's so long, you get in it, it starts making a little bit of money, you're in unrealized profit, and then it collapses and gives up the ghost and goes back down into opening range. Then guess what you do? You go right back to your workspace where you call upon that same information again, where it's on your chart, it's there. Then you're going to start watching. Did it just go down to take a stop loss hunt in the opening range? Because many times you'll see that sets up the PM session, then it'll resume. And then even in the afternoon, the 10 o'clock hour, first resistance area gap will be used in the PM session or during the lunch macro, which creates the very stellar long from there after the sell stop raid that went right back into the opening range gap. But knowing how to use the information, when to pull it up, it's got to be in close proximity. If it's not in close proximity, don't have it on your chart. It's simple as that. There's no reason to have something, in my opinion, 100 handles away. If it's not inside of a range of 100 handles, I'm not personally interested in it. I'm not concerning myself with it. But when we're in like 35, 50 handles away from wherever that, it can do that like that in today's volatility. But 100 handles away, I'm not all that interested in it, especially if it's against my underlying bias, because I'm not concerned with it. Does it mean I won't have a losing trade? No, I'll probably get stopped out and eventually have a loss. But I'm not worrying and obsessively considering the uncertainty of being right or wrong on the basis of things that are beyond the scope of 100 handles away from market price. and I'm not confident about what I just said. I know what I'm trying to say, but I don't believe I
I
did it
think I
well
know
in
what you're trying to
articulating it.
say as well, but like we're referencing an open range, so we reference the open price, right, Michael? Like, and when
Yes.
your PD array in the first presentation is getting the closest to open price, so us the traders utilizing that as our roadmap, and then as a way to recall. Because I mean, we all know how salient these PD arrays are from previous days up to 3 days within current price action or the existing day. So, I think that's really important for folks to remember as well. Like it's the reaction at another time off of one of these key arrays could really matter. But the opening price is what we're really anchoring to, and we're looking for that Judas, or at least I do anyway, that Judas or that failure swing. Right. And I mean, that then within your concepts offers so many different entry models towards any type of sessional bias or candle bias off that open, right? I think for traders to conceptualize that per your teachings is really powerful.
Yes. And by not at least adhering to that to some degree, you won't appreciate or realize the importance of the accumulation, then the manipulation, and then later distribution when it's bullish to a higher price where there's offset distribution later on, reaching into that buy side or inefficiency towards that weekly objective.
Which are very kind of advanced concepts that a lot of folks who are listening might not get. But what's awesome is you have such a strong community that you can just rattle off what you just said. And to the uninitiated, they're like, excuse me?
It sounds
While
like babble.
yes, no, but again, that's for the uninitiated. But for those who see and believe and have made money, then it just becomes second nature. I love that about the community, Michael, because having that unique language, it really, it kind of it solidifies your legacy. Because above and beyond you, when you talk about the ghost in the machine, we're utilizing a lot of the verbiage that you've provided. And I can tell you on behalf of lots of people listening right now, I know that they want to come up here and do nothing but say thank you. But on behalf and within the community, that gratitude needs to exude the conversation here, Michael. It needs to exude what we're doing, because a lot of folks are very, very grateful towards the terminology. And you just mentioned something as the author that, again, would sound like gibberish, or to the uninitiated, they have no clue. But to the folks that really understand what you just said, Michael, they're so grateful and thankful that you're here and that you're doing it. And I literally have had conversations. They're like, if I ever had a chance to tell Michael, thank you, I just want him to know thanks. So within the folks that are here, that gratitude, I want you to know it's really felt and exuded within the conversation. This energy transference, I want you to receive that gratitude from all of us. It's so collective, it's so enormous, and I don't know sometimes if you realize how many folks really, really are that sense of gratitude for your time and your energy and the language. I'll say the language, because the language, it's like music. We're reading a sheet. The candles have become a sheet, and your life's work has become this language and this philosophy and this way in which we can actually read music. So again, that ability, Michael, so many folks I know are dying to come up here, and they get mad at me in the DMs like, why didn't you let me come up? I had something I wanted to say. But
Mm.
for all of the folks who can't come up, Michael, again, on behalf of them, please, please just sense their gratitude and thanks for you being here. All right. I think that's really important. And I want to continue going in the conversation, maybe get Jason up here, because it's hard for you to say anything to that, Michael. Please, I want you to feel it. That's what I'm imploring here. So, and we'll just continue going if you don't mind. And if you want to add anything, please do. But
Yeah, I just want to let everybody know if they're going to come up, just know that I'm listening. I see your posts when it comes to me in my community and my channel. Even though you think that I read everything, whether it's good or bad, I see it. I believe me, Kit. I'm absolutely aware of the level of appreciation, and it makes me feel a little uncomfortable because it puts me in the feels, and that's the part that makes me feel uncomfortable. Not that I don't appreciate, I appreciate everybody's appreciation, but when it's like so much, it makes me feel uncomfortable because I don't want it to be about me. I'm listening to all of you. I want to hear what you're doing, and I get it. I get it, some of you want to just have that minute where you're talking to me, but don't do that to me because I'm not that significant of a person. I'm boring, and the relationship we have is I'm teaching. You learn how to do it, make it your own, and then share with me. It doesn't have to be here today. It can be in the future, but just share that with me because that's the only thing I'm asking for. And try not to treat me as a celebrity because it really makes me uncomfortable. I don't like that. But I'm listening
And
to you guys.
and thank you for reiterating that, Michael. I wanted to buffer the conversation with that gratitude. I know you're very well aware of it. Hopefully the audience understands as well. Just when we mentioned the term fight club, we don't have to talk about it. We acknowledge it. And I tried, I guess, in the elephant of the room today, it just even overcame me. I felt the need within all of the feedback I've gotten over the last few weeks to really just lay it out for Michael how grateful and appreciative we are. But then it's awesome that he's telling you guys, like, listen, this makes me uncomfortable. Like, it's nice, but don't do that. So the feedback loop that we get, that we give him and that he gives back to us, makes this very powerful, makes it very special, and makes it something that can really grow and amplify. And that's what we've done and what we will continue to do. So with that said, with that energy, Jason, you got your hand up. Farman's got his hand up. We got a lot of folks with their hands up requesting. Pretty please be patient. We'll try and get to you. And let's stay salient on the topic here. Okay. Jason, you're up.
Hey, what's going on? Can you hear me?
Yes, sir.
Beautiful, beautiful. Thanks for having me. Yeah, definitely a blessing to be in the same circle as all you guys. To be honest, I am one of the uninitiated, as you just said it, and I understood Ben's question when it came to like the clutter and like wanting to have all of those informations on the chart at the same exact time because you don't want to like lose or miss anything, right? I definitely like touch on that because as a new student, you want to make sure that you kind of understand everything that he's saying. So you're here putting all this shit up on the charts, and now you're trying to look at your setup, but you can't see it because of everything that's like drawn up on the chart, right? So I started doing a lot of like on TradingView and the platform X or whatever. There's like these where you can unlink the charts, so whatever you draw on one chart doesn't go onto the other one. So like let's say you're grading your premium and discount wicks, which is on the PD arrays or whatever. I'm still learning the terminology, but I would do that on my daily chart, on my daily chart, and then it wouldn't go on the 5 minute or my 30 minute, and then I would fade it out really really low so it could be there and I'm looking at my daily, and then on my 1 minute 5 minute I'll have it like really blended in so at least I see where it's at, and it doesn't feel like if it's so cluttered because it's like just in the background, like if it's part of the chart, right? I don't know if that works for anybody else, but I just wanted to kind of throw that in there. But to touch on the question, the main question that you opened the follow through for, as in what did you intake from his speak the speaking thing that he just did right now, and
Yes, sir.
the whole discipline part like stuck out like a sore thumb to me because that's something that I've been like working on so much because I've been understanding it. I understand liquidation. I understand price action, and I continue to study it every single day because I'm clearly a new student. But I didn't come from this whole background of business. I didn't come from this. I came from like nothing, knowing anything. So like he was one of the.
Yeah, bro. Tell us a little bit more about your story, man. Typically, when people come on, because it is important, we are a community. How long have you been trading? Right? Where are you from? How
Okay,
old are you?
well
And then
I'm
how do you engage with price, my friend?
100%.
Like that.
So
That's something we're curious of.
appreciate. Yeah, so I'm 38. I'm originally from New York. I reside in Central Florida now. I've been trading for 3 years. Been making profit for the last, I want to say, year and a half. But I just started learning the ICT mentorship, and I started doing that, I want to say, in the last 12 to 8 months, and that's really when I have been seeing my profits. I came from a crazy background, living by myself since I was 15. Grew up in the hood, pretty much self-taught. No family, no none of that, no parents. So everything was rough. So I learned how to teach myself everything so I don't end up, either dead or in jail, because that's pretty much what happens when you don't have any kind of uh direction in life, right? So as a young kid, I definitely understood that I had to tighten up and do what I had to do. Like, any bullshit that comes around, just push away from it, keep pushing for success, and be great every day. And I kind of just live my life through that. Luckily, this trading stuff has helped me. Not to get personal or nothing, but like the last 3 or 4 or 5 months, I had lost my job. Thankfully, I was learning the ICT mentorship, and I was actually trading throughout the time that I was working. So like when I had lost my job, I didn't feel too bad about it, because trading was a leverage where I was able to make my salary with trading without having to work. So that was like a good crutch. Um, what was the other question? Yeah, I have 4 kids. I have another one on the way, due December, January. So I'm excited for that. And it's been rough, but I use life as a lesson. I'm always a student to the game. I've been trading normally NQ. I tried to trade gold one time until I found out how insanely volatile and how much money you can lose in such a fast. So I'm like, yeah, let me fall back from that. I gotta definitely get my skill up on that. But I enjoy studying price action. I'm definitely going to be putting into my studies this week uh, why liquidity gets taken and why the primary function for the moves. Like I'm going to be studying everything that he stated. I'm just like I like being a fly on the wall and taking all the information in at the same time, because I'd rather listen to people speak the knowledge than be the person talking, because that's how you gain the most knowledge, right?
Well, that, and if you did have like, if you had a question, I mean, if you had any question in all of your studies, now would be a good time to ask. I appreciate the story, Jason. I appreciate you coming in, and I mean, we're here studying.
Yeah,
If you,
yeah,
I don't want to put you on the spot. If you didn't have a question, it's not a big deal. But again, it's a unique opportunity. So
yeah. No, no. Well, most like mainly it was just you wanted to you made the first question was you asked what was it that that rubbed off
yeah,
the
no,
most with
and you
that,
did a
and
great job, and I understand that, brother. I appreciate it. Thank you,
yeah, yeah, yeah,
really.
for
I
sure.
mean, excellence was the topic, is the topic of discussion. The idea of discipline, what's it take, the process of excellence. I mean, some of the things I heard Michael talk about specifically was documenting your losses and exhaustively documenting your losses. Don't sweep them under the rug.
Oh, thank you. That's exactly what you brought it back. So, discipline was like the main thing that's been staying stuck in me, because for the last 2 3 months, like everything's been working through, but due to my discipline, it hasn't been profitable. It's been
Well,
terrible.
let me ask you something, Jason. This is a legit question. Newer traders, do you have an exhaustive log of, as ICT mentioned today, your executions? More importantly, have you initiated or started any form of diary or communication with yourself dealing with your losses? Have
Yes.
you documented your losses?
Yes, 100%, and that
Okay.
is what's making me look into the whole discipline portion. Like start reading. I started looking back at my other pages, like journaling of what I've done in the past couple of months, and when I look at it, I'm like, yo, why am I repeating the same shit? Why am I continuing to do the same thing? And then I wrote on that as well. And this past week, I ended up, you know, getting back on the horse. I guess that's the best way of saying it, right? Like it was my first profitable week in the last couple of months, and I started just looking back at it and just started writing more about what it is that I need to focus on. And it really just came down to discipline. Because I'm satisfied with making a couple $100, but let's say I have a daily goal of 1,500 and I make 900, because I didn't make that extra $600 or $500. Now I'm here trying to make that extra 500, and boom, now I just blew all my profits. So like I always told myself, are you satisfied enough? Like you're satisfied enough. It's not like you're being greedy. You're not doing this for like just for shits and giggles. You want to make a living off of this and make everything happen. So why not just stop trading when you were up 900? So I started thinking into myself like, all right, it can't be this, it can't be that, and then it came down to discipline. And then when ICT brought that up today, it was like that aha moment. It's like, bro, this is exactly what you've been talking about. You just got smacked in the face with it. let's fucking focus and let's knock this out and let's focus on discipline and let's get it going. So I really just came on to say that, you know, I like the speech and everything that he was saying. It kind of just put fire on my ass, and I'm definitely gonna kill it this week.
Woo-wee. I love that, Jason. We're going to keep the conversation going, keep it flowing. We got a lot of folks here. 81 people are requesting to speak. You realize I can only have, there's a very limited number of people who can speak. So ask the question in the comments, pretty please. We'll peruse through the comments and we'll look to answer them to the best of our ability. Having your hand up is a very good thing. Thank you for understanding how we try and stay somehow organized in all of this. So we got Alex here, Juan here, Farman here. I got Pippi co-hosting with me now. We got IMRB in the house. I hope you guys have a salient question towards this idea of excellence and the actual topic of conversation that we had. We want to be within all of this, a follow through, a feedback loop, and we get to receive information and then we get to provide information. And that's a very good thing. So keeping the conversation going, keeping it flowing. We'll start with Juan, Farman, and then Custom Trades Alex. Juan, jump up.
Yo, I knew you're gonna put me in the spot. Sorry.
Hey, that's what happens, bro. That's what happens. So pretty please
I know.
tell us a little bit about yourself, where you're from, how long you've been trading, how you engage with price, and then any comment towards what we had in today's conversation.
Right. Born in South America, but raised a little bit all over the place. You'll notice that in my accent. But yeah, trading for the last 3 years, on and off, of course. But fuck me, man. Sorry for the swearing. The last the last 4 months have been fire. And it's fire and it's roasting, believe. So to put it simply, not mildly, because that's how it is with trading. It burns your ass if you're not diligent. If you know, when people hear about the discipline, oh yeah, I'll do tomorrow. Oh yeah, you'll put it for later. Nah, man, you do it now, you get roasted. Because at 9:30, that clock ain't stopping. That price ain't going back. You either you put your discipline to work, you do your diligent. I mean, you do your work diligently, all of that, or you get roasted. You get burned alive, man. You get cooked. And dude, 2 months being cooked, I started doing my due diligence, put my head down, put my work, in working hours. I don't care, man. I've been on the chart. Look, I ran through your 6 hours a couple of weeks back, and I'm just catching up with last week's trader roundup, bro. So I really appreciate you for that and all the time that you've been putting through. And you've seen me on and off on your streams.
Yeah, sense of urgency is real. Anyone that's here, anyone that's paying attention, we're here and we're just trying to offer and provide value. So this conversation of excellence, Juan, how did it resonate with you today?
Brother, I've got a bomb for you. Don't worry. I'm just answering your question. So
right on.
believe, and I think I answered all of them, right?
Yes, sir. Yes, sir. Yes, sir.
Okay, so let's keep it going. Short and simple. Where do I begin? Dear Michael, there is no Fight Club, okay? So I'll just keep it short and simple over here.
Shit. There is no fight club, buddy.
There is no Fight Club for me.
All right, let's go.
We don't talk about it. So basically, fibs. I mean, I've been looking at price. I've been engaging with your content since 3 years ago. And the last one, I mean, I'm halfway through, a quarter of your 2025 mentorship, but I've seen the 2016. I've run through the 2022. And now that I'm applying all these concepts and all the losses have been studied and all of that, basically every time I looked at a chart, it was like, oh yeah, there's a trade. And journaling takes care of that. So the question, looking at primes, looking at time, which I'm still working on, times of macros and the most important ones and all the cycles. And thanks to you, Kit, by the way. primes, time, fibs. Now, fibs, let me expand on that, because all of this has been like revelations. Okay. Placing a fib on the last week has been giving me insight into prices that have been attained this week. Of course, combination with primes and all of that. Now, adding the 3-day look back, using the fibs on the opening ranges of London, midnight, Asia, midnight, London, and then going through the New York opening range, placing another fib on that. It's not that it bothers me putting that on the chart and doing my due diligence and housekeeping and taking care of all that. That doesn't bother me. Mapping the fair value gaps doesn't bother me. I have been able to attain a level of success off the live trading, of course, because we only know how it affects the chart once you press that button and you really put that money in. But I've been attaining a level of success that I've never attained in the last 3.5 years, coming up to 4. Is this a right track? I'm pretty sure that I'm on the right track, but I have that kind of sense of, okay, do I really need to hear the confirmation from you? Am I really on the right track? Combining all these things, plus of course reading all the price, the way that you teach it, the priority on the fair value gaps, where they appear, and all this. And I'm just adding. I've run through 3 pens, and I've run through 3 notepads, just writing through the last month of.
So you're really still assimilating. You're assimilating a lot of this information, right? You're still learning how to trust it, right? If you're fervently taking notes, you're still learning how to trust it, right?
I don't know how to put that question into perspective, but here's my answer to you. The excitement in my voice should convey the level of success that I've been attaining, because the goal is real and the vision is clear. Because not just Michael said it earlier, that's the way it is. If you have a vision, and if you have things that put you on the right track, and you hear and you see the confluences and you see the confirmations, and you get on and on and on every single day, and you're like, it's like that guy that discovers the pot at the end, the pot of gold at the end of the rainbow. You get me?
For sure, bro. For sure.
It's that. Am I on the right track? Because I see the confluences, I see it hits, I'm just trying to see, okay, am I, because
the fact that you asked the question means that you're still assimilating this information and knowledge, at least for how I hear. Yeah, that's good.
I'm trusting it 100%, because I put my trades yesterday and they hit. I'm just thinking like, okay, that's Friday, but now that we're here, might as well jump on the boat and say like, yo, I'm here to rock. Is this how it is? Do you know what I mean? I'm here throwing the question because I have the chance, and we might not have the chance, but who knows tomorrow?
Yes. Listen, I'm reading, Juan, I'm reading a lot of the comments here. I'm trying to capture the pulse within the audience here. And the audience is asking or that we continue to have questions, and that we divert the conversation towards questions that you might have. So those of you who have your hands up, those of you who are here with a comment, we appreciate the story. Let's be inclusive with who's here as far as speakers, and let's ask questions. Very unique opportunity we have. So let's try and implore. One question I got in the comments, and it's a good one. I think this is a great question, and I'd like to lead with this from the comments, Michael. Someone's asking that you're grading daily wicks. What about candles that don't have a wick? That is a question from the community, a gentleman from Nigeria in my comments, and he's asking, do you mind asking ICT about high time frame candles when they don't have a wick? I actually think that's a great question for the conversation. I don't know, Michael, if you have an answer or if you'd like, or if we'd like to pass it on to other folks, but I'd like to recalibrate the conversation towards questions with Michael and getting his thoughts or 2 cents. So thank you, Juan. I'm not taking anything
Excuse
from
me,
you, brother.
sorry, excuse me. I'm not
Yes, sir.
trying to. I'm not trying to divert the question.
No. This
I'm
isn't
just trying
about
to
you,
step
brother. I'm
down.
trying to read all of the comments and all of the things that are being within the conversation here. So that's
I
where
get
we're
it.
at. It's not about you.
No. It's not. That's not the problem. I'm trying to step down. I'm just trying to be clear. Is my question? Am I on the right track with all those things that I mentioned? Just, I'm pretty sure that that's a yes. But
I mean,
I
I was
want to
trying to
hear it
answer your
again.
question politely and
If you don't
saying,
mind, or
yes.
you, that's
I
okay. But
mean,
thank you, and
it
I'm
sounds very
thank you.
much like you're still studying, and you will find more and more faith and trust, and you will answer that question within your own journey. I believe.
Got it. No problem. Thank you.
So, topic on grading wicks. What happens when there's a candle that doesn't have a wick? Is that an okay question? Crickets. Okay. My thoughts are 2 cents on it. It's just OHLC is what we're talking about. So, Michael, are you there?
Can you hear me?
Yes, sir. Yes, sir.
Anytime you have a range that has an absence of a wick, that even if it's overlapping with a candle prior to it and a candle after it, you can still treat that as a dealing range and you can grade it. It's just simply the same concept. Every range, okay, every range has the capability to be divided into sub quadrants, okay? But there has to be a reason to do it, not simply because, well, this looks odd. This doesn't have any wicks there. Maybe that's some kind of a clue. Maybe the universe is speaking to me and saying, hey, look, there's something special about this candlestick, so let me grade it. Maybe there is. But I don't look at that and say, wow, there's something special because it did that and there's no wick. With that, when I see something like a candlestick without wicks, instead of saying, let me jump on it and grade it, if I'm bullish, I never want to see the lower half of it traded down into in the lower timeframes. And then I just break it down based on that. So if you're bullish, the lower half of it should never be traded to. And if I'm bearish, I want to see it stay in the lower half of it, not quadrant, the lower half. So upper half or lower half in respect to it being bullish or bearish. That's the only extent I have towards anything like a candle that has no wicks. Hopefully that's enough of a response for them.
That's awesome. I mean, you just reiterated existing content for folks that don't know. Core content, month 4, order block theory. When you're grading wicks as the concept is introduced in the 1617 core content, and then in any of the other private mentorship stuff. But you're just going to grade the range based on how ICT is mentioning it. So it's the same concept throughout. So hopefully that answers. Continuing the conversation, we have Batman Shadow. Batman Shadow, what's up, buddy?
Hello, how are you doing,
Great
man?
name, by the way. I love it.
Yeah, how are you doing? I think we talked before, but I was a little bit busy. Excuse my language,
It's
but
okay.
we're gonna go through that.
Yeah. What are your thoughts? You got a question? You curious about anything? How did you
Yeah,
yeah.
let me reiterate. I think I introduced myself before. I'm an immigrant. I came to the United States like 2.5 years ago, and when I got here, it's the same thing. We were looking for American dream as always. Uh, I'm fine with working jobs, and I've tried like so hard to work in the jobs. It's just like I never had a job. Now I have opportunity to work. That's the biggest part of my life that it changed. When I got here, start working, uh, I was a little bit nervous. Like, is there anything more of that? Because I never graduated school. I can't go to just college study, be a doctor or an engineer. I was like looking for something like, is there anything else for my life that I can do? moving forward, when I was working in Walgreens as a cashier, somebody was trying to deposit money, and he was like, "I'm depositing that money, and I'm gonna start trading." I was like, "What's that?" And he never told me anything. I was like, "Oh, I make money from my home." I was like, "That's nice. I want to do that too." Moving forward, I start searching online, looking at as the same thing ICT explained, starting from retail as RSI. I was RSI, starting from RSI, working that to like I never had a success. Like I know the price is gonna diverge, and we're gonna see the indicator gonna lower standard divergence, and there's like hidden divergence. We were looking for that, but the moves already moved. Then they're gonna show me what the price is doing. After that, I was like confused. I was like, there is something to it that I have to find out. And looking forward, I introduced the ICT. Somebody told me, go study that guy. He's good. We are not gonna talk about like rule of Fight Club. First rule of Fight Club, we don't
Right.
talk
Fight
about
Club.
Fight
That's
Club.
right.
But I'm gonna say one sentence about thank you very much that you changed my life, and you are the figure of the history. Like the way that we see the price, ask somebody else that they see price 10 years ago. They never saw the price that we see today. The community sees, and the ICT sees, and everybody else that sees in community. I'm like so impressed with what the state right now that ICT is listening to me, but I have so much to send it to him.
That's good,
I have
bro.
sent it so
I'm
much,
smiling ear
but
to ear because I know how happy you are.
yeah, and like I send us so much. I have so much discovery for today. For like the past, I started trading like 1.5 years ago, and I already saw like the profitability wasn't me because I was sleeping in the car, working 18 hours, 14 hours, supporting my family, and I blew that account. I knew it. Like it wasn't about the profit. I was like, I want to be like Michael. And I know I never gonna be like Michael. Nobody gonna be like Michael. But promise, I want to be something like him. I want to read the price like him. And I started studying. He has 98 Twitter spaces. I listen to all of it every day in a work. I know I sleep to work. I have to listen to him because everything that he said after my break, I'm gonna know that. He talked about today about typical study. For him, it's typical study. For me, it's discovery. I have a folder of discoveries that if Michael see that, like I know it's not gonna impress him because he know the source code.
Bro,
He
he's
know how
impressed
I'm
with
working with
how
it.
I mean your excitement is infectious in this conversation. I think everyone here can sense how hard of a worker you are. I think it's obvious that you work
Yeah,
very, very hard, and
I
you also have
work.
a tremendous sense of maturity, my friend. So
I'm
I
19
know you're.
and
I can tell that you're young, and I can also tell that you're old, brother. So kudos,
yeah,
kudos. Good for you, brother.
and I'm not working. I'm sending my family from my back home, and my family is happy. They have a great life. I have a great life in here. But for me, that I'm not sitting for this vloggers. Like when you come from that kind, you want everything. It's not like about the core. You never saw a post from me. Like I'm not in the social
No,
media
that's
to
fine.
show
Yeah,
other
you're
people. That's why
totally.
he saw.
You're just a
But
guy, right? That's
but
great.
but come here. Yeah, I can. I'm making my own paycheck. When I start making my own paycheck, and when I was going through.
Oh, you muted yourself, buddy.
Oh, sorry, I was somebody talked to me. When I was going through that, sorry about the connection. It just happened. When I started going through his studies, I found a lot of stuff, and I was going through that study myself, and like I knew there was something else to it.
Let me ask you, with
I
all of your
started.
studies, you're engaging with price.
Yeah.
How you engage with price? Talk to
Okay.
us a
Let
little
me.
bit about how you engage with price. And there's a lot of folks here that want to talk about trading with ICT. So you're
Yeah.
here, and I
And we're
love
gonna.
your
Yeah.
story, brother. But people want to talk trading. All right. Let's
Yeah.
keep
Yeah.
the
Sure.
conversation salient to, again, your story. It's very important how excited you are. It's important. But let's get back to trading. The entire audience
Yeah.
is frothing at the mouth at the opportunity of asking questions that are salient to trading with their mentor who is here listening.
Yeah.
Okay? All right.
Yeah.
I'm just
I
saying that for the
probably dropped
entire
some.
audience that we're here trying to do it, right? So high five,
Yeah.
everybody.
Yeah. Yeah. I'm sorry. Like, I
No,
know
you're
I'm
excited,
like
brother,
the
and
same
I
thing.
love you
I'm
for
going
it. I
off.
love you for it. I
Yeah.
love you.
I'm upsetting like a little bit. It's just like for me, that's how I am. But if coming for topic, how I engage price, your first question.
Yes, sir.
For me, is my market maker models. I see the prices. He talks about the fractal. I'm gonna go through that too. The fractality of price and the time. We're gonna combine that. I was like going through that for market maker model. For me, it's just like I can see SMR forming in a low every day. Like I'm not gonna catch that low. I know there is a total soup. Total soup is a first confirmation to me. I'm not gonna enter that on that. I want the high probability. I want to risk my money for something that's gonna give it to me for like not 100%, like close to 100%. And that's how I going through it. For me, it's just
So do you
he
wait
talked
you wait for
ICT
the
talked
first
about
stage of reaccumulation? Are you looking for that for
for
the
no
engulfment or the
for
up
me it's
close
just
and then the retracements into that SIBI or BISI?
yeah for me it's just I see the for I go back to see forecast. I graded my levels as the ICT showed us 20 24 25, but for me it's just like he talked about his favorite model is just the second stage of market maker model. That's for me. I always go through that. I know there is a first stage.
So you
When
wait
I
for
can
it
get
to
the first
breach the
stage, I can
50%, and then you want to see it
yeah
return
after
back
50.
into discount after it's breached 50%. All
Yeah,
right. I mean, that
if I can
ICT has
enter
talked
the
that about that very specific model here on Trader Roundup. So I love that you're bringing it back up. That's a nice loop. That's a nice
yeah
360-degree circle. I like that.
yeah, and for me just time is important. Like he talks about the macros, and I have my own macros. Like it's just like fractality. When he talks about this something I have in my discoveries a lot.
What's your
For
favorite
he
macro?
talks
What's
about
your
the
favorite
1 hour
macro?
macro.
What's your favorite macro?
950
Woo! Boy, that's a good one.
and 250 to 250 to
I
310,
like that one
345,
too.
315 to 35, and the last macro that we're gonna see in the price is the last this last hour. But for me, uh, I can get the whole dealing range in a classic classic the classic range that he
Like the
explained when
classic buy
it's
or sell
the
day,
with
right?
the low.
Like classic buy or sell
Yeah,
day
when the
with a market
when the
maker model and etc.
yeah when the low form is around 9:30 to 10:30, I can get the whole range. But for me, just like when I get like I have two supermodels. One of them high frequency trading that I gonna go in and I get out. As he talks about hanging fruit, that's hanging fruit every day. I can trade in an Asian session just for 15 minutes. I can get my trade in a London session. Any hour of trading, I just see the range and I can trade it. But for me, it's just like I want the high probability. What's the high probability? New York session. Everybody likes New York. The move is super fast. We want an NQ super fast. Get my money, get out. For me, when I got the distribution of the range that I'm looking, the fractality that I'm looking for my hourly hours, I get my 10 pips, I'm out. And I gonna rest. I'm not gonna come back for the short. Oh, the move is already moved and it moves like 50 points. No, for me, I got my money. I got my profit and my family is and I eat. That's all I need. But I can the questions for the discovery that I have. ICT talks about one of his videos that everybody's saying time and price is fractal, but we classified as fractal, but it's not fractal because he gives two examples for us. One of them was about your local temperature is fractal. No. If you flip the coin, the result is fractal. No. but we classify it as fractal. But I just want to say what ICT thoughts about that, because that's when I see the price, I see that the ranges and the fractality goes, that if it breaks from from exterior, from interior to exterior, or exterior to interior, I'm gonna get in. I'm gonna see my distribution. When the distribution comes, I can get in manipulation. But is it too risky for me? Yeah, I can see it. It's just the total soup is right there. It total soup. Now the first accumulation or first stage of distribution is happened. I can get in on that. But for me, second stage,
All
I
right.
can get in on that too. But
Batman.
the question that I had
Okay. Yes.
was how we're gonna elaborate on the fractality of price, what he meant by that, that time
That's
and
a pretty
trust
deep
is not
that's a pretty
fractal.
deep question.
I know I wanna level out the bar. I have so much, but
No, I
that
appreciate it.
when
I
I
don't know if we're at, the fractality of the market and life, and what is that, right? I don't know if that's what this conversation is, right?
yeah, I know, but if he gonna explain, but for the conversation today, I I have a discoveries, and I love to look at. I have
Bro, do me a favor.
for the
Do me a favor.
opening
Do me a
prices.
favor.
Yeah.
I need you to take a deep breath, okay?
Okay.
And I need you to calm down. I need you to put yourself on mute, and you're going to listen to the conversation, okay?
Sure.
I love you. We've got limited resources as regards to time, and you're very excited, Batman. Don't want to minimize that. But as the host, I got to be here and I got to make some tough decisions. Decision is we're steering the boat. We got to refocus. I want to get back to trading. I got two private community speakers here, and trades don't lie. We talked about the first Prezi, the bullish and the bearish. Today, I'd like to have that conversation, get back to a little TA. I got RB here. I know he trades a Venom model, which is very interesting, and I'm sure he has some form of I don't want to speak on behalf of either gentleman, but I'd like to welcome them to the room, and I'd like to try and get us back towards trading with ICT in the room, and he is here to listen.
Can you
But we,
can you hear me, Kit?
yes, sir, I can, brother. How you doing?
Yeah, I'll just get right back into it.
Yeah, thank you.
I have a really simple question that I think that a lot of people aren't aware of or really should be thinking of, and Michael might not even be aware of it. But with the new world of AI, since everyone has the ability to codify their own indicators and algorithms because the AI now speaks and writes the coding language, what's your thought on actually codifying our own algorithms? Where would we begin? And how much of your language and concepts should be put together in their own systems or separate systems that talk to one another? And kind of just like going to open it up to the IA or the AI trading, codifying your own algorithm kind of conversation.
Out of left field, Michael. Woo-hoo. Deep breaths. Hope you're in for the conversation. Seems pretty in depth. We down to tackle that?
Hopefully he's still
the unmuting thing. There you got to realize that there's like a process here. So we have a delay in our conversation and referencing or talking to Michael.
Can you hear me?
And then
Yes,
sir. I knew there was a delay, and I knew you were coming on. So yes, sir.
If you could repeat the question one more time.
Yeah. So in today's age with AI, it's able to write code for us. So any regular person who has an idea or a specific, systematic way of, just writing out what they want, how do you think, and what's your recommendation or any insights on actually codifying our own algorithms or indicators, right? I've done over 150 different indicators. I've codified a lot of things for Kit. I'm working on my own algorithm testing suite right now and just creating a bunch of different things in Python and creating my own algorithms. But I kind of wanted to just make you aware of, or, ask you some different questions, since you talk about algorithms and you talk about the algorithm that controls price or your algorithms. Now that regular people who don't have a coding background like yourself can codify algorithms, how should we begin? What are your thoughts on that?
I do actually have a coding background. I have a degree in actually computer science, especially in information systems. The depth at which this topic would require, like we would have to completely go off into a whole new discussion. But part of the things that will lead up to the release of my books to prove that I don't want anybody having to pay for the books to learn extra stuff. Everything will be on my YouTube channel, so you don't need, again, it's not a plug for my books, but I will talk a lot about algorithms and their place in early stages of electronic trading, present right now, and what I think the future holds for it, and how we as independent traders and how we could code and codify our own ways of implementing price action into a usable algorithm that is a model that's maybe automated, like completely automated, where you're not even doing anything, it simply does it for yourself. Those are topics that obviously go beyond the scope of something like today's discussion.
Yeah, no, that's absolutely fair. But yeah, hey, I look forward to learning more about the algorithm talk. As a charter member, I remember the first videos of your algorithmic theory, and it was change in state of delivery, and from there I was hooked on this, seeking and building systems and just thinking of the market in an algorithmic way. And I think a lot of us love that type of talk, and I look forward to more of the programming side of it for sure. So thank you.
Did you have programming background before you started learning how to trade, or was it a result of learning how to trade that got you into that?
It was a result of the first presented fair value gap. I wanted to codify my own indicator to see the first presented fair value gap of the day of week, the first one of the week, or first one of the month, first one of the quarter, stuff like that. And just from moving on from learning PineScript to now I've built a couple different web apps, and I'm helping with a statistical trading platform, and just running through and creating my own sets of data. And I still am not, like, I don't know, because the AI coding kind of just does it for me, but I do a lot of validation testing, and I run through and I go from one model to another and make sure that it's structured correctly. And I've done a lot of studying. There's this
To be clear, though, and the question is, do you have the background? And with the advent of AI, Michael, what Trades Don't Lie is saying is he doesn't know anything about coding and AI and its advent and its coming. And as you've mentioned, since the first presentation, Fair Value Gap, the topic, AI has become such an enormous force for someone like Trades Don't Lie, who has such an abundance of information towards these concepts, that he's been able to feed that and train AI into creating these systematic models and approaches that are then automated in the way of framework, right? So I'm just trying to add context to the conversation, right? So he didn't know anything, Michael. And the world that we live in today, and not knowing anything about coding, that doesn't matter. Right. Talking to AI is wholeheartedly everything that they need. If they understand your concepts, they can train AI to your concepts, and then they can create these automated systems, which are actively being done.
Like, you can just
use and it's a very new thing,
Yeah.
right? Like, since the first presentation Fair Value Gap, that topic, that's this year. That's this mentorship.
Mm-hmm.
Yeah, it's
well, not if you think about it, in other older, I passed it on, like, you guys consider like the first. I only went into in-depth teachings with it recently, but I dropped it to see if anybody would run with it. But as far as, well, let me ask you a question. Since you obviously are delving into coding and things of that nature, do you agree with what you have exposed yourself to and learning about it from that perspective? Can you see how individuals that have learned coding and understand how algorithms work, how I teach would probably be more beneficial to people that from that persuasion coming to me.
Yeah.
That was like the biggest bridge I had to cross, because like, how do I get this across to people that never considered thinking like this? Because it's very difficult. It's very, very difficult to come up with a way of teaching something that, if you've never been associated with it at all, you have to learn how to talk about certain things.
I think the hardest.
Andrew, do you want to jump in?
Yeah. I think the hardest part is it under like your tutelage is like believing, and it's not that I don't believe it, but the hard part is codifying it, is having like an algorithm that kind of just runs all the time and is using every component, right? And I don't think that's the proper way, and it might be, and yeah, I don't know Enigma or anything, but I think that turning systems on and off, and knowing when to turn systems on and knowing when to turn them off, and having a plethora of toolkits like you provide us with, all the different PD arrays and concepts and narrative building tools that you've given us, to actually codify that into a real algorithm is definitely the hardest part. So I've kind of just like done what you've done with the charter, where you just said kind of, here's 13 price action models, right? Here you go. I would almost rather build a set of tools to then build out different models that I could. So just different systems and arrays that I can plug in and plug out with any modelistic, environment that I want, and just run through and test it, right? Obviously you have to test for overfitting to make sure that like, it's just not, you didn't tweak it to make the historical data perfect, right?
No form fitting,
yeah.
Right? I will say this. It's important for you to know that if you're pursuing more, more involvement this way, or just the understanding of it, the automated side of things that I do, when I say Enigma, okay, I have things that I can run scripts and they will do one primary function. I don't have everything that I know in conceptual form, where it observes price action, identifies it, and then swings into, okay, well, we're going to use this model. Every script is an individual model. So it's dependent on the criteria being met based on what I believe. If I believe the market's going to be bullish, I can go in and I can pick 1, 2, or 3 different scripts that I believe is going to be functional for that given session or that given day. Then the algorithm will look for, this is the criteria that I'm expected to see in price action, because I put that logic into it. If it's there, it'll spit out the information to put in a trade, to put a stop loss, to manage the stop loss throughout there, and I need not be there at all. So if I don't have it where it's like literally, the guy's name escapes me.
No, I understand what you're saying. You don't have a master algorithm that picks all your mini algorithms, essentially.
Yeah.
You are
I'm
algorithm.
still right. That's why I say I'm Enigma. But the automated side of it is me pre-selecting what I believe is going to take place in price action, which is how I teach you as students to do manually.
Okay.
And if you have the aptitude, and if you have the time and the investments that you want to make in terms of putting that together, you have the logic, but do you have the coding, repertoire to put that to task? Is left up to be determined for whoever wants to try it.
What's fascinating, if you don't mind, I'd like to jump in here quickly, is, when we talk about algorithmic trading, as someone who has jumped into trying to codify your concepts, Michael, the idea of an upward model, a downward model, layering your concepts algorithmically towards profiles, I believe are some of the strongest ways in which we as a community, and as we're growing, it's layering concepts. And the idea of an up model or a down model has very specific components to it that can be defined algorithmically. I can define them within 5 very specific components, an up or down model, based on your teaching, right?
Mm-hmm.
So where and how we are layering concepts towards market conditions is how we could then propose the idea of automating, within limit orders or within scripts. At least that's my thoughts or 2 cents. Again, I too, as Andrew has mentioned, I've codified a lot of your concepts, and you teaching just the verbiage array.
Yep.
Code is array. If you don't
Right.
know in code that you're utilizing the term array, that is a codified concept. So that in and of itself is algorithmic, the term array. And for someone the uninitiated, and we have quite a few of those here, a lot of folks just learning, where some of us have been learning for a long time. So we get to add that perspective. And that's what the market is perspective. It's angles, right? Where are we looking at things? How are we layering your concepts and your concepts in up model? For example, a down model, for example. It was easy to identify the Wednesday consolidation with the 10 o'clock high being swept and then the news driver happening in the middle of the week, on the middle of the day, seeing the 2022 after the 240 point displacement lower, right? Very, very quickly in one candle, exactly as you teach it. So, I mean, the if-then statements, as you've taught, it's more important for us as a community, I believe, to be layering these things. It's not simply ever one. It's layering a profile, for example, and a high time frame array, for example, with the low time frame entry points.
Mm-hmm.
I don't know. That's my thoughts. I just wanted to add that. What
Well, that
you're
would
asking the
be,
question, so.
yeah, that I think that would be the primary goal to develop continuously doing, but initially you can do well just with having one simple model, one PD array, building on a basis of bias if it's bullish or bearish for that given day, waiting for the market to move into some measure of discount relative to what it's already offered at the time you're entering the trade, looking for the setup. And it can be streamlined to something as simple as that. But you can make it as complex. Like you can make it absolutely ridiculously complex and so many hoops it's got to jump through. But you'll probably get 12 trades a year. And is that a model that everybody that's listening wants to trade? I guarantee you they don't. Nobody wants it. And you can make $1 million a year doing that model, but it's trading it's so infrequent. They don't have the discipline to sit still and just do that. So by teaching things that have high frequency in nature, because if you think about what I've taught, everything that I've taught, whether it be optimal trade entry, because it can be applied to all time frames, the first presented fair value gap, that's an everyday model. Now, if you really understood it, it's an every hour model. It presents itself every single hour, but you have to be inclined to be using a 15-second chart to use it. But it's there every single hour because there's always market internals that are shifting, and these algorithms are going to fire off of this type of volatility. And you can capitalize on that by using ultra small time frames, sub 1 minute. But everything I taught was to give you as students the tools to go in and make it whatever you want. If you want it to be a working class hero type model where you can't look at lower time frame charts, but you can trade a daily chart, but you have to require the weekly and the monthly to act like we would view a 15 and 5 minute chart respectively. I get that question all the time. Like, how can I do this? How can I do this? If I can't be in front of the charts all the time, I have a job, I have a family, I have a university, then trade a daily chart. Use big stops, very, very low leverage, and the monthly and weekly are your higher time frame, just like a 15-minute and 5 minute would be for a 1 minute model. 1 minute is just to prove that there's no shortage of opportunity, and it's high frequency in nature. That means you have lots of examples to go back through and back test. And that same application being applied to any other frame of reference for time, whether it be a large time frame model or an ultra short term sub 1 minute, all of them are algorithmic. But how you are applying them individually that fits you personally, that's the hard part. And that's what I tried to create, an automation where it could do everything. And it was so many conflictions with, logic would overlap, and it would create barriers for me. And it was a coding nightmare for me. I was just like, I can't do it. I had friends that I trusted to work with me, and they were still having troubles with a lot of things. So I wanted it so streamlined. I wanted to be able to sit there and watch it come to life. And it only can be done in my own hands, and the people I've allowed to have hands on it is one model or two that they're closely related to. And what I mean by that, if I have a buy model in mind, a buy program underway where the market's going to be bullish for the next day or two, I will have a primary function of looking for discount, opening range, looking for some kind of, it's just things I talked about today. You use one of those as a particular model. And I want that to be the logic in which I want to see it trade on. And once it does that, Then I can use the lunch macro, which is it pulls back down into a low that's formed at 10 o'clock, and it will cycle back through 10 o'clock in the morning on a 1 minute basis and find the closest, okay, at 11:30, it finds the closest 1 minute low that formed, but it had to form after at 10 a.m. So 10 a.m., the filter is go back to that reference points in time, and then what's the lowest low, but it's the closest one going back from 11:30. So what is it looking for? 90 minutes of price range looking back, and it's finding the closest proximity swing low for South-South liquidity. That I'm going to use that as a scalp if it's enough range in terms of handles. I'll take that as a short, and then I'll reverse, go long after the sell side's there, and it'll automate and do it all by itself, and then it'll run into the last hour of trading, and it closes at 3:15. No matter what the market's doing, it just simply will close the trade at 3:15. That's the logic I put in it. That way I don't have to overthink it. I don't have to worry about it. I don't have to babysit it. It's just done. But you can see how there still has to be some kind of hands-on and understanding of what I expect through, like you were mentioning, Kit, market profiles. Where am I in the weekly range? How will these puzzle pieces of what I think the daily range is going to form as on an individual day-by-day basis because of experience? And yes, this is a very, very complex way of doing it. And for someone that's thinking like, wow, I have to do this to learn how to trade, like, no, absolutely not. But you're listening to a guy that was a freak with this stuff for 33 years. And I wanted to do all kinds of things with it. Like I wanted to make it where, you know, I wanted my kids to be able to say, okay, I'm going to get up, I'm going to put this in, I'm going to push this button, and I'm going to just let it do what it needs to do. And there it is. Because I didn't trust that, you know, my kids, and honestly, they're not as good as I want them to be. And I'm struggling with that as a dad. I feel like the dad that went to, you know, a specific alma mater, and I went in to follow in suit and, you know, play on the football team like dad did and all those things. I never did that stuff, but I can relate to that because I want them to be the better version of me. Like I want that. And they're encountering the same things that you all encounter. Like they get in the way. Their own character flaws get in the way. Their impatience get in the way. Their want to design. You think it's impressive for you to come to me and say, look what I was able to do with what I learned from you. And you want that interaction with me. And as much as you want that to happen, my kids want to do that, and that gets in the way. So you can imagine what an impediment that is for them, because they want to be able to say, it's in our genes, it's in our genes, it's in our DNA, and it's not. It's a skill set you have to work your ass off for.
Gems. Oh my God. 11:30, that technical that you just gave. I got to keep the conversation going. The board we have has some fantastic questions, and I'd like for us to just address what some folks have asked, Michael, if that's okay.
Sure.
Cozy Babe asks, I want to ask him the importance of candle 3 on an imbalance. If candle 3 on a BISI is a down close candle, it usually only wicks in an FEG. But if it's an up close, candle 3, it puts a down close candle inside the imbalance. A question from a friend. It's written in the thing on the top. You can click on it. I'm not sure if you can see it, but she tagged us. It's in the comments. So I'll reiterate the question one more time if you'd like.
Please, one more time.
All right. I want to ask him the importance of candle 3 on an imbalance. If candle 3 is a BISI and is a down close candle, it usually only wicks in an FEG. But if it's
is the imbalance candle number 2? Are you classifying it as a buy side imbalance, sell side efficiency, or is it a sell side? Like, is it SIBI or BISI?
Commented as it's candle 3 and it's on a BISI, and it's a down close.
Okay, so when I heard you, I was interpreting what you were saying as she was indicating that candle 3 is a BISI, but then the down close was confusing. So, okay, so it's a bullish fair value gap. It's an up close second candle, and the third candle is a down close candle, correct?
It usually only wicks in an FEG, but if it's up close, candle 3, it puts a down close candle inside the imbalance.
Not all the time. If she's seeing it, it's just something that's just recently happening. But the third candle's up or down close has no basis at all in terms of what the effect's going to be inside the imbalance. So try not to spend too much time worrying about that.
Okay. Okay. Very, very good. Cozy Babe. I hope the questions there in the Tron. Next question from Andy Gomez. Michael, do PD arrays have a hierarchy? Rookie question. Do different PD arrays have more pull than others? That's a good question. The
Well,
gravitational pull maybe of specific arrays versus others. And before you answer,
no.
Michael, Pippi, if you can continue finding some of these questions and throwing them on the Jumbotron from there, if you get a chance, it's a really, really good format for what we're doing right now. It keeps the trading conversation salient. And these are questions from the folks, which I'm sure Michael really enjoys. So, yes. Anyway, Michael, I didn't mean to interrupt. Just trying to host a little bit here. So please continue.
The idea of, is there one PD array that supersedes or has more significance or draw or pull than another? And no. The key is to know what your dealing range is at right now. Where are you trading inside of? What range has created the buy side? What range has the defined sell side? That dealing range, and then you apply your bias to it. Are you long term? Like for instance, the weekly chart. If you're bullish, you expect the price to rally higher. By having that understood, you're expecting this dealing range to do what? Move to the upside and discover something above its short-term high where buy side is. If that's the case, you now can frame discount and equilibrium and premium. So not every PD array inside that range, you'll apply the PD array matrix. If you look at month 4 of 2016's mentorship, when I introduced the PD array matrix and the PD arrays, I give you a generalized outline of how they are structured generally in price action. But I also mentioned at the same time, you're not going to see every single PD array in any given price range. So you are forced to know what? At least an overview of all of them, even if you are really, really focused in on simply doing a fair value gap entry or an order block entry or a break or something to that effect. Whatever that one trick pony PD array is for you, it's not going to be better than the next guy or gal that's using my concepts. It's the one that occurs to form when you're bullish and it exists in laying inside the discount range. So the only importance or affinity that I have towards one PD array over another is its placement, its existence in the given price range at the time of the trade setup, and not all of them form. They don't all exist in every price range. They don't always appear like that. So the ones that appear in relative terms to when you're bullish, you want to see it appear and form in the discount range that you're trading in. And when it trades down to it, you want to see it do what? Perform as it should, provide some kind of discount sensitivity, and vice versa. If you're bearish, you're looking for weekly prices to trade lower. There's an inefficiency below current price action, 100 handles or so or more. That could be a filter for you. And that means you have potential range of 100 handles. Do you expect to get all 100 handles? No. Then you use that bias on your daily chart and sub daily, anything lower than that time frame, and you're looking for shorts, and you frame your dealing range at the time of day, and you look for the premium arrays, and whatever premium array exists in that range, it may not be a breaker in there. You know what I'm saying? So you're not going to be able to see a breaker. If the market just completely breaks aggressively lower, and it never created a retracement high or created another short-term high on the previous high that it dropped from, there's no breaker there. So you can't force something that doesn't exist. So you have to simply look at what exists inside the premium portion of the dealing range that you're forced to engage in. And whatever one exists in that respective discount or premium range relative to being bullish or bearish, that's the one that's salient. That's the one that makes the most impact because that's the one that's going to use. So there's no subordination, parenthood, control over, no importance, no strength of stronger than this one. There's none of that. It's just a matter of discount, premium, current narrative, in the dealing range you're operating in.
Beautiful. RB, you had a question. I see it's here on the Jumbotron. You also have a speaker tag. Would you mind pretty please jumping in, asking your question?
Yeah, I Kit. How's things, bro?
Pretty good, brother. Pretty good.
Yeah, just got some family engagements going on, but I'm glad I got on here. Hi, Michael. Just a few. Hang on, just walking a minute. Right, let me sit down. Right. First of all, regarding you mentioned a couple of weeks ago regarding the new week opening gaps and the gradient levels, event horizon. But my model, sorry about this, let me just go back to my model. My model's based off the first presented fair value gaps. And you've obviously answered my question just now about every hour. But my question is, when you say go down to the 15-second chart between 9:30 and 11 o'clock, and if you frame the gradient levels from the daily or H4, and a PDA is aligned in time between, well, your times are 9:50 to 10:10. I use 5 minutes before for SMT. But my question is, reading the body structure, when it leaves that area of interest, and then it goes to the next level of gradient, using the voids and the volume imbalance. Now, I go down to a 10-second chart, and I use the market structure shift, and then it just goes there. I'm hyper scalping, I am really. So my question is, regarding my Venom model, which is different to yours because I think yours is a BPR, I use my Venom over opening ranges. Now, these opening ranges are specific to what you said in the 2016-2017 mentorship. I won't elaborate too much on that because, as you say, not to talk about Fight Club. So my question is, why does it happen basically every day?
I'm actually not sure. I'm not sure what your question is. If it's, I think it was more like an observation. And I
Yeah.
apologize if I didn't.
Yeah,
I didn't pick it
no,
up.
I kind of caught the same thing. I honestly think we kind of caught RB off guard because you answered the question, and then I called on him, and he's having to come up with another question. Is that right, RB? I mean,
Yeah.
for what it's worth.
Yeah,
I mean, keeping it real. So, I mean,
If I
that's what
may,
it is. Yes, please.
I believe when you started talking, you said something to the effect that I did answer a question. I think it was relative to the every hour, there's a first presented fair value gap that's modeled, but you have to be forced to use a sub 1 minute chart. And it exists there all the time. Either it gives you the trade setup or it doesn't. And you mentioned by doing that, using the 9:30 to 11 o'clock, I don't believe I said that. It's simply a measure of the top of the hour, okay, at the beginning of every single hour during high volume times of the day, meaning the New York session, morning session, pre-session, 7 o'clock to 9:30, the 9:30 to 11 o'clock, it can be applied there too. The afternoon session, 1:30 beginning the PM session, because you have that initial 30 minutes time, the opening range for PM session, to 4 o'clock close. Those are high volume times of the day. And then London open. They're very, very rich with volatility and liquidity is available to really take advantage of all that. At the top of the hour, during those times, not the entirety of the session because it's divided in 30-minute intervals and sometimes, but the full beginning of a new top of the hour, you can use that 1 hour range with a sub 1 minute chart, 15 second, and the first presented fair value gap. When you're bullish, how do you determine that? Well, where do you expect price to draw? You've done the analysis on the higher time frame. You're expecting the price to move higher or lower. So you're either buy a program or you're a sell program. It's simple as that. There's no complication there. What complicates it is you see moves that occur counter to that initial analysis, and you want to be a part of that. So you think that I'm going to throw the baby out with the bathwater and I'm doing bias wrong. When you're not doing bias wrong, there's going to be fluctuations in price action all the time, going different directions. They stay in consolidations longer than you want them to do. You have to stick to a bias and only take the trades that are germane to that bias. Using the 1 hour rule for first percent fair value gap on an hourly basis. During the rich times of liquidity that I mentioned here, kill zones basically, top of the hour, when you are in line with the price now moving in favor of your bias, that means you're bullish. Maybe it's done its work with the opening range for like NQ. Let's give it an example for context. You're bullish. You think it's going to rally 200 handles based on what you see on the weekly chart. There's an inefficiency above us and a relative equal high that it's an even stronger draw for. Wonderful. That means I'm going to be bullish. I want to see the initial open be a premium gap. It trade down into the opening range gap. And then maybe SMT exists. I don't have to have it though, but Dow goes lower. NQ says I'm not going any lower. And ES says I make a lower low. So comparatively, there's a divergence between the three averages. That's indicating that there's a shift. Now they're going to send it higher. NQ is the instrument I'm trading. I want to take the trade on first presented fair value gap. So the first buy side and balance sell side efficiency fair value gap that forms, I'm going to wait for it to drop down into, and I'll go along with that. Hopefully it's in the upper half of the opening range gap, all boxes being checked. Now, I can use that as a criteria, and I wasn't able to get long because I wasn't in front of the charts. I did it wrong. I read it wrong. You know, something happened. The dogs got my attention. I spilled something. Anything. Human things pop up all the time. And I didn't get that entry. At 10 o'clock, I can drop down into a 15-second chart, and I'll look for the first potential fair value gap there, and I'll go long on that. And then there you go. At 11 o'clock, same thing. First potential fair value gap at 11 o'clock, top of the hour. If the objectives hasn't been met yet, I'll go long there. That's why sometimes you'll see in the morning session, you ever seen days where the opening range, you know, the first hour and a half or so of trading, it's moving, but then you don't get a lunch reversal. You don't get any kind of retracement back into the range that was formed in the morning session. It just keeps on going and going and going. And these big trending days, I had to come up with something because I was missing all of that many times. I was like, if I didn't get the one good entry in the morning, I missed it. So the 1 hour first presented fair value gap at 10 o'clock and 11 o'clock are perfect for those conditions because it'll get you in sync with a market that's not going to retrace much at all. So as soon as you see the first BISI that forms at the top of the hour on a 15-second chart, I'm in on that. I'm all over it like white on rice. I'm going to get there because if it fits the criteria that I don't expect the lunchtime macro to retrace back down into 10 o'clock hours low when I'm bullish, that's a model I'll jump onto and plug it in play. That's how I would use it. Would I go in every single hour and simply just trade the first presented fair value gap? No, because there has to be criteria behind it. So I know there's listeners thinking, oh, wow, ICT said I can go in there and take the, no, that's not what I said. There has to be some measure of context applied to it. And the perfect example for me when I use that model is when the markets is simply on a go, 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 baby, and never returning back into the opening range or the initial part of the first part of the day prior to lunch. In other words, whatever it's done between 9:30 and 11:30, there's 2 hours of trading. If the day is strong, and there's simply no interest at all going back down into the opening range gap. Say it gaps strong and just starts ripping higher. And yeah, you might have a first presented fair value gap that formed in the first 30 minutes, but it ain't coming back down there either because it's just ripping and roaring. It's just something happened. Like something took place geopolitically. And it's just reacting to this monstrous move where they can just destroy a lot of people. Top of the hour, 10 o'clock, top of the hour, 11 o'clock, 15-second first presented fair value gap. I will take that trade all day long and I will never miss it. I will be in there doing just that very thing. And that's an application of how I am comfortable doing that model. Now in Forex, you know, when volatility was high, when I was running those accounts up really big, I was using a lot of the things I'm saying here on an hourly basis because the volatility was so expansive. It was so, like, it was wonderful. It was really, really nice and so much volatility. We're seeing the same thing with NQ and the indices here, but there's a whole lot of knee-jerk reactions where in Forex at the time when I was doing all that, you didn't see that. It was this really big extrapolated runs one direction, then the other direction, then the other, but it was real smooth, no erratic double back and forth, second and third passes to old highs, and then it moves. There's a whole lot of manipulation right now. Volatility is nuts in indices as it is right here. So you got to be careful. Don't just say don't do what I just said here and think, wow, he said go in here and trade the first 15-second bearish fair value gap when I'm trading bearishly and I'm looking for lower prices simply because it forms on the 15-second chart and it trades there. You can get crushed doing that. There has to be some greater magnitude of context applied to it, not just simply on the basis of it's the first one that formed. He said so. You understand what I'm saying?
Market condition.
Yes.
The
Yes.
proper context, the proper market condition.
Yeah.
Sound to me, just jokingly, kind of sounded like a gold model. I mean, gold's the one rip roaring these
There you
days,
go.
so
Look
kind
that's
of
a
sounded
perfect
like a
example.
gold model to me.
Go back and look at it. Look at all the days on the
Yeah,
big run up and see if it ain't there. It's there.
for a year. I mean, that model's probably steady Eddie on
Hmm.
gold because, I mean, from the Asia protraction on, that can be that model. Those conditions you just explained very, very clearly. Wow. I have a question, and it's through the comments, but I think it's very salient because we are coming up to a time change within London and within New York. How do you, Michael, deal with the time change with us being time-based traders? How do we navigate those waters? Because it's very inconsistent with one changes and then a week or so later, we have this period of time. I think that's a great question. One it's been burning on my mind to ask too, and it was asked within the community and within the comments.
Well, for the folks that went through paid mentorship and they had the opportunity to listen to me describe all this stuff real time over real price action and anticipate these things before it happened. The rules I stated when it has to do with like daylight savings time and springing forward 1 hour, springing back 1 hour, and adjusting for time. There's about 2 weeks of just muddled price action where just anticipate the level of precision to be just slightly off as everybody gets acclimated to that, because a lot of big money simply isn't going to push through their levels of orders until this natural cyclical thing that takes place twice a year, once it subsides, and then things get back to pristine delivery and price action. So there's usually a 2-week period. So perfect example, we're getting ready to go into fall back an hour, and for 2 weeks just allow for price action to do things just a little bit before or just a little bit past the kill zones and the macro times. That's a normal thing that takes place during those 2 weeks. And when you see it, it's not them changing the algorithm, it's not them breaking something and making it impossible. It just simply means that it's a regularity that takes place on a consistent basis that will always exist, because I wish they would do away with daylight savings time. I can't stand it. I don't like it. I can't stand it. It's annoying. And there's a lot of countries around the world that don't even observe it. So why are we even doing it? It's stupid. Did that answer your question? I'm not sure if it
Well,
was satisfying.
yeah, I think a lot of folks are going to be really, really happy because the new folks, that's something that's definitely a topic, and it's going to be happening very, very soon. So yes, I think for the folks who did not, learn this through your private mentorship, that are learning it maybe now for the first time or hearing it, I'm sure this adds a lot of clarity for them. You're telling them there's this 2-week buffer, not to stress so much about the precision within your time-based models, right?
Mhm.
I mean, okay, that's awesome. Um, Keeping the conversation going, keeping it flowing. We have a phenomenal question here by Profitable Loser, and he asked, or he states, he's like, I doubt I get a chance to talk. Just like to know what keeps ICT's flame flowing with all the success within the markets and his teachings. What is his why to keep on providing despite the backlash and negativity? Proves that even in life, the move is more valuable than the money. It's a great question. It's a great question. What's your why? What keeps you going, ICT?
Well,
I know that's a deep question, and it takes maybe a bit to unpack, but I think it's a good, at least cursory question. You don't have to unpack it completely, but I mean,
I will say it as succinctly as I possibly can, given the amount of time that I want to pour into it. But I've said it in exhaustive format in other places. Um, I'm a person of faith, and I asked the Lord to help me when I couldn't figure none of this stuff out. There was a time when I couldn't tell you anything about price action. I was unable to see anything happening before it happened. I was 20 years old, floundering, desperate, and I came to my wit's end, and suicide was on the table. I was not feeling well about myself, and I just cried out. I said, "Listen, I need help because I'm feeling reckless. I feel like I'm hurting myself, and I don't feel comfortable being here anymore. And if you help me with this, I will spend the rest of my life helping other people do it too. And it'll be like a ministry. Maybe you're behind it, maybe you're not. But if you are reading my heart, and I know that you can because you're who you are, you created me. If you open my understanding and open my eyes up, I will spend the rest of my life sharing this and helping people, encouraging them with it. And this is me keeping that end of the bargain.
You're making me cry. Is someone cut onions in this motherfucker? Because, god damn. Got some onion cutting going on in this room. I don't know why. That's so beautiful, bro. Anyway, guys, lots of onions in the room. I'm sure they're getting cut. So, Pippi, you had your hand up. You're co-host and brother. We briefly talked about gold. If you got anything you want to add to the convo, you want to ask the mentor, pretty please do so. Putting him on the spot, he might be working as well. So
I do actually have a question, actually. So what are your thoughts in regards to hidden gaps? So what I mean by that is, and when I say hidden gap, I mean a close to a open. So for example, let's say we're talking gold, right? And the settlement price is roughly 130, right? But the open is at 820, right? Is there any correlation you have to that in relation to like the indices, how it's a different settlement price to a, using your settlement price as your close to a open, right? Because like on TradingView, if you look at gold on the RTH, it starts it at 930, which is really not the open, right? The open is really 820. So is there any correlation you have to, settlement price close, right? Using that as your close to a open. So it would be different for oil. It would be different for obviously gold and the bonds, right? It would be a different, close to a open. So what's your thoughts on that? If I, if you understood exactly what I meant.
Yeah, if you remember, I get a lot.
He definitely understands what you mean.
The times when I talked about having the settlement tab in the lower right hand corner of TradingView toggled on or off, the question always comes up. What's the criteria for having that toggled on or off? What do you do? I do both, and as I taught this, I do it. I get measurements on both of those prices being as they are, and having the relationship between the open and close. If you toggle settlement on or settlement off, you're going to get a difference or a disparaging range between what it's showing you as a settlement price and the actual close, and what you can do with those ranges. The same thing we've been doing, like with opening ranges, new day opening gap, something to that effect. It's salient information, it's useful information, but not everybody's going to be willing to do that extra step. But the ones that do will get more insight than those that don't.
So in other words,
thank you for that.
That's some sauce right there.
Thank you for that.
That's
I appreciate that.
Sauce.
Yes.
Pippi's a charter advanced ICT student asking what I would consider in listening to it an advanced question that might have gone over the head of some of you guys.
It's intended to.
Yeah, you're really, yeah. There's a lot to unpack with what was just said. If you go back and you pay attention and you listen and you rewind what Michael just said in this conversation he's had with Pippi, it's really strong, really, really strong. So we'll leave it at that. Wonderful conversation. 12:35. I like the time. Just gonna say,
there's a question in the tab from
yes, please,
from Black and Blue. Hold on, let me see if I can pull it up. Hold on 1 second. Okay. How do we know when to ignore volume imbalances? Is it if they form on a suspension block? What about when the gap up or down happens at the top or bottom of a move? Sometimes the volume imbalance manifests on a 1 minute, but not the 5, and that's a sign to ignore it with the question mark. So
volume imbalance is
go
something
ahead.
that you should never ignore. Never ignore it, because if you remember when I first started talking about that PV array, it's the one that's the most flexible, or I have to be and you have to be the most flexible with, because it can pass through it several times. You can use it many times. But once it lays a body over top of it, and it's delivering under the premise of the narrative you're looking for. Let me give you an example of what I mean by that. You're bullish. You think price is going to go higher. It's an early portion of the day, and prices drop down into the volume imbalance. It's going to offer many instances for high frequency trading algorithms to place orders in that range multiple times. And because they're not trading with exorbitant risk, they know that the likelihood, because they're on side many times, because they have the understanding I'm trying to convey all to you, they're on side, they're looking for prices to go to a particular direction, magnitude's going to be on the upside, the biggest portions of the up close day. Never ignore or discount the volume imbalances. But if you get the return back into a range and it's in a very deep discount and outside the range of the opening range gap, and you're bullish, I would disregard any interest at all for the market to trade down into a volume imbalance to that extreme. But if they're occurring inside the usable trading range that you're working within, like something that's reasonable, it's in the scope of what's permissible. And what do I mean by that? If it's in the upper half of the opening range gap and you're bullish, if they form, never ignore them. If you look at how my executions, many times I'm adding every time it trades into those volume imbalances, both passing through it on the downside and upside. If I'm trying to go long, I'm using that many times to add and pyramid larger positions on that. I was doing that many times with Forex. When I was running those accounts up to millions of dollars, those things were happening on lower time frame charts. You're not seeing it, but you're just watching the arrows be building on that chart and building the position larger and larger and larger. So in context of using or disregarding, if it's inside the dealing range that you're operating in, never ignore it. But if it's outside of the range that you're anticipating, where it's permissible for price, if it's bullish, it should not go beyond this measure of like the opening range gap, or I'm trying to find another example that would be as direct as that, because I really know better off the top of my head I can think of based on what I've already revealed. The opening range gap in itself. When we're bullish, we want to see it stay in the upper half, leave some measure of it open, and 10 o'clock comes, it should start spooling higher, reaching for the buy side liquidity. If it's a buy day profile that you're underway and you're expecting higher prices, you would not expect any volume imbalance that's formed below that opening range gap low to be of any insignificance or use. But otherwise, if it's inside the opening range gap, it can revisit it again during a lunch macro retracement. And it could trade many times, just go right down into the volume imbalance, fill that with a wick, and then that's the low of the session after the macro retraces and gets that liquidity, and then off to the races it goes for the rest of the day. It's done that a lot in ES and NQ in the last few months.
Dramatic pause by design. That was, I wasn't going to say anything there. So just for the folks that want to go back and they need that time stamp, we left it there. So we have Alex. He's been a regular. He's asked some questions to you. Alex is got his hand up. Pretty please, Alex, jump in here if you don't mind, if you have a question.
Yo, what's up, kid? I really
How's it going, buddy?
Oh, it's going great, man. I liking this conversation. I have to learn a lot. I have taken some great notes here.
There's some advanced.
Yeah,
There's
it's
a
advanced
lot.
stuff here. Which I
There's a
love.
lot
I
here.
love advanced stuff, you know. So, my question would be like, he mentioned today in the space talking about the first presentation, like he was saying, if I'm correct, if I heard correctly, you should use the first presentation gap from the previous day and cast them forward from the next day. So it can add more confluence through price to have more confluence to see if price gets back there and goes to the other direction. If I'm correct, I mean, I want to. If let's say if I cast those forward, the
That's a
first,
good question,
you
buddy.
know,
It's a good question.
I
I
cast
think it's a good question.
these things for because I know I'm going. I've used it also all my chart. I use these RTH gaps. I'm using the copper quadrants all the time, all the week. I have these
Yep,
things.
and he did talk about it as well. So,
Yeah,
so
yeah,
Michael,
and
your thoughts and response, if you don't mind.
the the premise behind extending any PD array, not just simply the first presented fair value gap, but it goes with the first breaker that formed from the week, the first propulsion block that forms. If you delve into these studies as topical studies and spend some time in them, you're going to see trades originate or terminate at these levels on such a consistent basis. It's like the scales fall off. You start seeing, wow, they're really using this old information, and it's not old and archaic, and it's not used by somebody else's logic. It's something that never has been talked about before. And you're not going to observe it and appreciate it until you seek it out and see it and start keeping references and logs of it and over and over and over again. But when I talk about first presented fair value gap, the premise is first start on Monday. We all have the opportunity, in a couple days, Monday will start. And the first presented fair value gap that forms, you toggle that, extend to the right. The way it's useful is, imagine you're a rock climber, okay? And this is the analogy I use with my youngest son, because all the other things I try to explain to him, it doesn't make any sense to him. But if you're looking at the sheer rock surface in front of you, and you're looking up, and you're just like, I got to get to the top of this rock surface and get to the height, the plateau above me. I have to map out where I'm going to put my hand to grab a handhold. Where am I going to put my foot? How, based on my height, where can I place my feet in holds in the surface of the wall of the cliff to be able to push and spring myself higher so I can reach to just outside my normal arm's length to grab another handhold with my other hand, and then map out the next possible reaching point. And while I'm doing that, where will I put my feet? These are all like footholds. Well, I use the first presented fair value gap and the concept of projecting it forward. Many times, if I'm in a trade, if it trades back down to it on another day, I will add to a position and build the position larger. Or if I let something go because I expected a deeper retracement and I didn't want to be a part of that deep retracement, I'll institute another new trade because it's based on strong footing. I've already mapped out the expectancy that I'm going to use this. If I'm bullish, if it trades back down to it, it's going to have sensitivity. What kind of sensitivity? Discount sensitivity. And I don't want you to listen to what I'm saying and just attribute that as, well, he said so, so I believe it. Don't do that. Go into the studies of looking at it, how it's used, and you'll see there are trades that are forming that social media, they're always reacting to these types of things. They're always like, where did that come from? What just happened? Did they just have news? Did Trump just say something? No, it's using that first presented fair value gap, and it's using it 2 days after it's formed. See, when you do it and you place it on your chart, and the day closes and it starts another session, you're going to look for what? The new first presented fair value gap. But the ones prior to that one are still going to be used by the algorithm. It's cycling back through what? 20-day look back, 40-day look back, 60-day look back. But to make things easy to manage, just simply go back the last 5 days. That's it. All you got to do is keep a workspace with first presented fair value gap in the last 5 days. And every time a new day forms, go back the oldest one 5 days ago and hide it. So that way it's not overpopulating your chart. You only have 5 of them. And then by cycling through your charts and your workspaces like that, you're constantly putting intel and your understanding about, okay, price is getting close. We're 30 handles away from that first presented fair value gap that's 3 days ago. It's not old. It's not stale. And if it trades down into it during a macro time, what do you think is going to happen? Boom.
I'm going to translate this for the uninitiated. ICT PD arrays have memory, market memory, and it's up to you to utilize the salient array in the trade plan. And what he is telling you is these PD arrays have a form of memory. That is the boom in all of this. I'm translating, Michael, because you do a fantastic job, but there are still some folks that won't get it. Previous arrays matter because there is a algorithmic, we'll say, memory. And that is the analogy, I think, very clearly presented by ICT within all of his studies, within his entire life's work. And he just keeps peeling it back further and further and further. And for those who are listening, the uninitiated, the brand new, the first presented has been in his entire work, and he's just now recently uncovered it. So what does that tell you as far as the importance of it? What does that tell you as far as where and how you should frame trades around it? That's up to you to find. And that's what he's stating very, very clearly. Do not believe a word this man says. You have to go back and find this yourself. You have to convince yourself not only that he believes it and that he knows how to trade it and that his entire community that have been studying also believe and trade these same concepts, but you, the uninitiated, the Fortnite trader, the brand new gambler, needs to take TA and transform that into becoming a trader. And this is the TA that you want. This is the cream of the crop in regards to TA. And it just keeps getting more and more and more clear to you, the student. And it's up to you to prove it to yourself. That's what Michael's telling you, and it's don't believe him. And it's
Go into
beautiful,
it with
man.
a skeptical mind and try to disprove it. That's the fun approach to doing it. Go in and see if you can beat it up and prove that it doesn't hold water. That's the easiest, most fun way to build confidence in it, because when people go in and they try to discount it or say it doesn't work, that's why no one's ever came forward and said, look, it fails here, it fails here, it fails. No, use the logic I've taught it, and you'll see it's just like that. Perfect precision, Swiss piece, timepiece. It's what you want to believe about support and resistance, where they show you that they pick the right old low, but there's multiple ones in that cluster, so there's no rhyme or reason why they're picking that one. They don't tell you that in the books, and I have over 2,000 books, and none of these books ever gave a systematic approach to showing horizontal support and resistance. This is the one you look for, and this is the one that's going to work. So you can have an old high and highlight it with a trend line segment or horizontal line on your charts. You can do that, sure. And you can wait for price to drop back down to that old high broken turn, resistance turn support. The break and retest, the classic, what everybody thinks I'm teaching. I have no idea what that is because I don't teach that. I don't want it to come back down and touch that old high, because if it's bullish, it won't. It won't do that. If it can come back and touch the old high that just broke, I'm highly suspect of seeing it rally after that. I think it's going to retrace back into the range a little bit more. And that might be a false breakout turtle soup. I might fade that whole move when everybody else would see that as, oh, I'm buying resistance, broken turn support. Having an understanding of first presentation and limiting your scope to the last 5 days, you always have the last 3 days in the last 5 days, right? I mean, it goes without saying, 3 days is incorporated in the count of 5. So when you have a swing low or swing high form, it takes how many candles to do that? 3. So if you take that into account, what you're looking for is how these first presented fair value gaps or first presented whatever PDRA you want to use. I just taught the fair value gap because it's visually aesthetic. It's easy to see it. It stands out. Once you identify what it looks like, it's easy to jump around in the chart and see, well, there's an example over there. There's an example over there. Anybody spending 5 minutes with what it looks like can find it in a chart, even your 5-year-old. If you say, find one of these, and there it is. But using it in context is something altogether different. So you have to have a little bit of understanding of bias, narrative, time of day, what central tendencies the market does around the first hour of trading, and then off to the races the market will start creating its daily range. But it provides you an unambiguous way of saying, this is going to be support that I have highly trusted in before because it's proven itself based on time and price. And when it trades back down into it again, it's reasonable to anticipate, if you subscribe to the view, and that's just what I'm trying to get people to entertain themselves. If the market is algorithmic, that means it's not hurting you, it's helping you. It's not a disadvantage, it's highly advantageous for you to see it that way, because it strips away all the fear, because the monster of uncertainty that lurks on the hard right edge and just past that sea monster in the deep, deep waters of uncertainty that hasn't never printed a candlestick in yet, those hours in the day that the market hasn't traded to yet, that's scary. That's scary territory. It's uncharted territory. No proverbial pun intended. It's simply unrealistic for you to have some of the fears you have as a trader, where what if it does this and what if it does that? In the beginning, you have all these crazy uncertainties that plague you. But when you start stripping away what is essential to me to understand right now based on what's in the market price action, and focusing on these old footholds that price has used that are not old swing highs and swing lows, they're simply a point of reference for where prices algorithmically deliver price higher or lower. And having that measure of anticipation, presenting opportunities for you to get into a new long, into a new short, adding to a position that's existing, or many times collapsing the trade and saying, okay, I'm content with it trading there because I don't believe it's going to go any higher for the week. It's already reached that relative equal high, or it traded up into that premium inefficiency. So I don't subscribe to it needing to go any further this week because we've moved all the way till Thursday, and Thursday is a transitional day. It could create the high of the week or the low of the week on Thursday, and Friday just be an inside day or a lower high or higher low, and need not make a higher breach on the weekly range that's been established at that time. And then you can use a first presenter fair value gap when it trades up to it, but not breach the high it's already formed for the the intra-week high, and you're content with that. And then many times you're going to see that that was the best exit point, and you're not going to discover its efficacy until you study it and build a library of examples of, wow, this really, it has a systematic approach. And if there is an algorithm, and I'm going to speak hypothetically, if there is an algorithm, what frame of reference would it use to go back to recall old points of reference? How would it do that? And what mechanism would it use, and what criteria would it follow to hand pick with any measure of importance? What measure of significance is it attributing to any point of reference at all? So what you're learning is the language in which you can visually see it doing these things. And it's never existed in other schools of thought. It might look like a supply and demand zone because I draw a rectangle to highlight it, but what I'm teaching is not supply and demand function at all. It's very, very specific. We're looking at time instruments that are forming within price action, and we want half of that range to be sensitive, and we don't want to see the upper or lower half, respective to being at bullish or bearish, be traded into. And they can be used again, which completely nixes the idea of supply and demand because they want some fresh zones. These things stay fresh for 60 days. Think about that. You're not going to see that at Online Trading Academy. They would never teach that principle. And that's why it was funny when people started saying, well, he's teaching rebranded supply and demand. No, it's not. There's nothing like this. I can tell you when these, if you want to call them supply and demand zones, I can tell you when they're going to form. They can't do that on Online Trading Academy. They have to wait for them to form. They have to see them break higher and then come back down and get into them. I don't need that. I told you where inversion fair value gaps were going to form before they were in the chart, in live stream, with no delay, the lowest latency. And that is just to defy all the naysayers that would ever sway you into thinking that you're better off learning something else. Go ahead and listen to them. Go learn the other stuff and see if it can do the same things that I'm teaching you to do with this. And I promise you, you will come back to this. I've had so many people leave and say, well, I'm going to try to do this. This is complicated. And then they can't do something they were promised by someone else, and they come back here. Now they have a desire to build themselves back. They have a real purpose behind it. And you need to have that. If you don't, this isn't easy to learn because it's a lot of thought processes required. But you have to determine how you're going to fit as a trader. What you're going to bring to you as the trader is the tools that which you're going to use to encapsulate your model. I don't force a model on you. I give you all the tools, all the paintbrushes. The market is the canvas. That chart is the canvas. You have to determine, how do you think? Do you think in terms of, I want to see a big runoff market in a market that's already been a bullish market for a while, and I'm comfortable trading that. Great. You're going to use a model that absolutely takes advantage of something like that, but you're not going to do turtle soup shorts when the market's bullish like that. It doesn't fit your criteria. It doesn't fit your personality. You don't see the market that way. And that's not a nix against your understanding. That's not something that's negative, that you're subpar in terms of a technician. It just means that you have the ability to focus on just that model, and you're limiting yourself in that capacity only, and you will excel doing that. You're not going to make yourself better by having everything, the kitchen sink approach to applying everything. You just need one criteria. What makes you bullish? It needs to be simple. I believe the weekly chart's going to go up to an old high, or it's going to go up to an old SIBI inefficiency. I believe it's going to trade up to, and there's range to afford that. I mean, it's about 100 handles or so. So that means you have 100 handles that you can take advantage of. Do you want all 100? No. You have to be realistic. If you get a piece of it, if you get 20, that's good. It's a good stepping stone, but you're not going to get all of it. And by having the understanding of a general overview of the PD arrays that I've taught, and the best place to do that is month 4 content on the 2016 playlist. It's for free. It was paid mentorship level content. That matrix of where they usually form in relationships to one another. Not that they're important over another. There's no one PD array that's better than the next. It's just, it gives you a general overview. So that way, even if you are a fair value gap trader or a breaker trader or a market maker, seller, buy model trader, and you like the second stage of redistribution or redelivery, or reaccumulation rather, that might be your thing. But having an understanding of what volume imbalances are, having an understanding of what propulsion block is, you have a better understanding of reading candlestick by candlestick delivery and price, which is going to aid you in having the faith that's sticky with your trade. Because you can have the greatest understanding about, yep, I know how to do the optimal trade entry. I know how to do the 2022 model. I know how to do the unicorn. I can do the breaker. I can do the gallo. I can do venom. I can do all these individual things. But what do you do once you get in? Because you have to submit yourself to, is the trade still viable? And every little down close candle when you're long, unless you know how to read individual candlesticks, it's going to make you second guess. It's going to cause you to feel doubt, like, oh man, I don't think this is going to work out. I better get out of this trade, or I better move my stop loss and lock in some profit because I might be wrong. So having an understanding how price delivers, propulsion blocks are wonderful because it's giving you an indication that, yeah, that candlestick that you're watching form and it's digging down into the old order block to the left, that down close candle, it should not go halfway and close halfway of the previous order block. And when you see it do that, it might wick into it. Then when it closes, it's above the upper half. That's confirmation that you're on side. To the next candle, you want to see it create an up close candle, and you want to see it move higher and move higher. And the next down close candle, you want to see, is it reacting to the last down close candle, which is the what? The propulsion block. And that's how you read order flow, tape reading it live. You don't need level 2 garbage. You don't need any of those gimmicks. You're simply watching price live and breathe literally on your chart. And it's like reading the future. And it's so confident building by seeing it happen in your own hands, and no one can give you that skill set. You have to earn it by watching price. You have to be there watching it live. You cannot do it with market replay. Market replay is absolutely insufficient. It falls short. You cannot get this information or skill set acquired with 1 or 2 fluctuations in market replay. You need to see real price action. And if you can't watch it live because you're in uni, or if you're running a business, if you're working at the time, then simply invest in a screen recording application that records the entire day. And then go home, eat your dinner, do your family time, whatever, and then watch price action. I promise you that will be the biggest investment you can place on yourself in understanding, and it'll supersede and make no matter what books I write ever, the language that you adopt by seeing real price action with the things I've taught here in the scope of the vocabulary and what we look at in terms of PD arrays, and your time in front of the charts watching it live, that can never be discounted. And nobody can replace that with anything better, because you're getting it through your internal dialogue of what you're seeing in price action. It gives you immediate feedback. It's immediate reward. It's immediate instruction. And that's the only way you're going to learn to hold trades. It's the only way you're going to learn to trust the setups. And you won't fear down close candles when they're forming. You'll know that it's looks like it's going to be a down close candle. It's not going to close low. It's going to spit, go backwards, and there'll be a big bullish up move on this very candle or the next one. And when it starts happening, you're like, wow, like I can see this before it happens. And it's back to that same analogy I gave earlier. You're driving down the road, you see a car in front of you. They're going to come in front of you in the lane, and they're not going to signal, and they do it. You're thinking of a song, you turn the radio, it's on. You're in the zone. You are in that. The military calls it OODA loop. Like you're dialed in. And the only way you can do that is by tape reading and watching price action. No entries, no setups. You're just simply watching price and the ebb and flow that it creates. And by having the understanding of first presented fair value gaps or first presented NEP data array, it gives you forecasting of this is where that guy is going to change lanes without a signal. When price comes down into that old fair value gap from 3 days ago, or 2 days ago, or 5 days ago, that right there, I expect the price to react there and go up. And how much it moves remains to be seen at the time, based on wherever you're at in the range that's been delivered so far. So it gives you a great deal of advantage to anticipate and have a prognostication that otherwise escapes everybody else in the retail universe.
Dramatic pause again. Pippi, you had a question. Melky has a question.
I have to tell you, I apologize, but
yes,
my wife just came in.
We're done. Yep,
we are
All right.
at that moment.
All right. 101. I like the time, guys. I like the time, 101. So we're there, and we're going to end it as Michael has requested. So thank you, everybody, for being here. Thank you for all the comments, all the DM requests. The next, if there is a possible format, I think maybe a questionnaire or something I push out might be easier. I think the Jumbotron was very nice. That was a great way to kind of organize things and try and keep the conversation on topic. I know everyone listening, it's very important that they have questions. They want to know TA content, and Michael being here, again, eternally grateful, Michael, for taking the time and energy and the follow through. And I mean, we had some tech difficulties in and out, and that is what it is. But this was, I think, what everyone could have hoped for as far as a follow through. So, again, thank you, Michael. Thank you, everybody, for listening. Thank you for all of the comments, all of the DMs. We'll do our best to organize those things, filter those things, and keep those questions burning and topical, and we will be answering them. Right. So thank you, everybody. Have a great one. Peace.